$7. In 2002, an online bookstore traded at $7 a share. Most Wall Street analysts predicted bankruptcy. That bookstore was Amazon. Today, its market cap stands at $2 trillion. Who sold? Who held? And in a Silicon Valley turned ghost town, what remained? When a bubble bursts, wealth doesn't disappear. It moves. We track the path. In 1995, a gold rush swept Silicon Valley. The vein was called .com. That August, a company listed on NASDAQ. It made web browsers. It was called Netscape. The company had zero revenue. Yet on its first day of trading, the stock more than doubled. The market read this as a signal. No revenue required. Just add .com to the name. 1999 was the year that signal hit full amplification. In a single year, 476 companies listed on U.S. exchanges. 78% were tech. And the more striking number, 76% of those companies had never turned a profit. Not once. The deeper the losses, the higher the first-day pop. In 1999, unprofitable tech companies averaged 81% on their debut. Profitable ones averaged 40%. The market wasn't reading losses as failure. It was reading them as proof of future growth. The NASDAQ started 1995 at 743 points. 5 years later, it hit 5,048. In the same period, U.S. real GDP growth ran at 3 to 4% per year. The gap between price and reality had gone astronomical, but no one called it a problem. The Federal Reserve moved first. From June 1999 to May 2000, the Fed raised rates 6 times, from 4.75% to 6.5%. When rates rise, the discount on future earnings rises with them. For companies that had never earned a dollar, their distant future value began to mathematically shrink. For those surviving on promises alone, this was a quiet death sentence. March 10, 2000. NASDAQ hit 5,132 intraday. Then it began to fall. On April 3rd, a federal court ruled against Microsoft for antitrust violations, an order to break the company apart. The symbol of big tech's invincibility fell in a courtroom. NASDAQ lost 25% in a single week. Fear spread. The IPO market froze. Venture capital phones went silent. Companies that had only shouted growth with no revenue model began to fall. Their oxygen was external funding. When the oxygen stopped, the suffocation began. There was Pets.com, an online retailer for pet supplies. In February 2000, it listed on NASDAQ. IPO price? $11. Every sale it made was a loss. It sold at 27 to 33% below cost. The more it sold, the deeper the deficit. It bought Super Bowl ads, built a dog mascot, spread marketing nationwide. The money ran out. On November 7, 2000, 9 months after listing, it announced liquidation. Share price? 19 cents. $300 million in venture capital, gone. Pets.com was one, but hundreds fell with it. Webvan, eToys, Global Crossing. Between 2000 and 2002, roughly 500 .com companies shut their doors. There was Cisco Systems, a maker of network equipment. In March 2000, Cisco's market cap was $555 billion, number 1 in the world. When .com companies started dying, new equipment orders stopped. In April 2001, Cisco wrote off $2.2 billion in inventory at once. It laid off 8,500 people. Its stock fell more than 80% from its peak. Empty buildings appeared across Silicon Valley. Bankrupt startups broke their leases and left. In Q4 2002, office vacancy in Silicon Valley's outskirts hit 28.7%. 2 years earlier, it had been under 1%. Engineers packed their bags. High-end office chairs appeared on streets for nothing. There was no gold. The miners left. The town became a ghost town. On October 9, 2002, NASDAQ bottomed at 1,114 points, a 78% drop from its peak. Roughly $6.7 trillion in global market cap had evaporated. Half of US GDP, erased in midair. Individual investors watched their 401k retirement accounts disappear with it. Engineers who had banked their retirement on stock options were left with nothing. But there is a different question to ask. Where did the shares they sold go? Where did the talent, the patents, the servers of dead companies go? Not who went bankrupt, but who picked up what was left behind. Wealth didn't disappear. It moved. Ownership transferred through three paths. The first path. AOL used its inflated stock price as currency. In January 2000, AOL announced the acquisition of Time Warner. Deal value, $165 billion. At the time, the largest corporate merger in history. The numbers expose the structure. AOL's revenue, $4.8 billion. Time Warner's revenue, $27.3 billion. In asset terms, AOL was 1/5 of Time Warner. But AOL's market cap was $164 billion. Time Warner's was $97 billion. AOL's massively inflated stock bought Time Warner's real assets. Time Warner shareholders received AOL stock, not cash. By the time the merger closed in 2001, the dot-com bubble had already collapsed. AOL's business model, dial-up internet, had been left completely behind by broadband. When the bubble deflated, what Time Warner shareholders had received crumbled like paper. In 2002 alone, a net loss of $98.7 billion. The largest single-year corporate loss in history at the time. Time Warner's new CEO later called the merger the biggest mistake in corporate history. The second path. Insiders exited near the peak. Between 1999 and 2000, Bill Gates sold hundreds of millions in Microsoft shares every quarter. Paul Allen reduced his portfolio substantially in the same period. When they sold, someone bought. Individual investors at the bubble's peak. The insiders converted shares into cash. The retail investors converted cash into shares. When the bubble burst, the side with cash survived. The third path, and the core transaction of this episode, Amazon. In late 1999, Amazon stock was at $107, one of the hottest names on NASDAQ. When the bubble began to burst, the market decided Amazon would share the same fate. It had no profits. In 2001, Lehman Brothers analyst Ravi Surya published a report warning of Amazon's possible bankruptcy. Amazon stock kept falling. Between late 2001 and early 2002, it hit a low of $7. Market cap, $2.8 billion. But Amazon had already planted the seeds of survival. In February 2000, just before the bubble burst, it issued convertible bonds to European institutional investors. It secured approximately $628 million in cash, 1 month before the capital markets window closed entirely. That decision was decisive. While competitors died of cash starvation, Amazon held its position. Cash became not a defensive shield, but an offensive weapon. As rivals disappeared, Amazon's customers had nowhere else to go. Amazon filled that space. Third-party sellers began selling on Amazon's platform. Inventory-free revenue. Commission income rolled in. Ghost town infrastructure flooded the market at bargain prices. Bankrupt dot-com companies' servers and network equipment hit the market. Engineers had nowhere to go. Amazon absorbed that talent. In 2003, Amazon turned its first annual profit. Net revenue $5.2 billion. Net income $35 million. Small numbers, but 2 years after a bankruptcy prediction. Amazon didn't simply survive. While competitors died, it absorbed their customer base, logistics infrastructure, and talent, and grew larger. A new tenant moved into the ghost town. They hadn't come looking for gold. They wanted the empty buildings and the roads. When the bubble collapsed, the market was redrawn. Amazon's 2002 market cap, $2.8 billion. As of 2024, $2 trillion. The ghost town became the world's most expensive city 10 years later. But the owner had changed. On the same ruins, Google rose. Online ad demand from dying .coms concentrated on Google. Amazon and Google built the foundation of their market dominance in this period. The .com bubble, in effect, cleared the ground for them. Warren Buffett avoided .com stocks throughout this period. That judgment was correct. While NASDAQ fell 39% in 2000, Berkshire Hathaway stock rose 26%. But avoiding a crisis isn't the same as capturing the opportunity. Buffett missed his chance to invest in Amazon. He missed Google too. Berkshire's subsidiary Geico had been buying Google search ads in bulk since its earliest days. He was watching the business model from the inside. I was a core customer of Google through Geico, and still, I didn't invest in Google. This is a terrible mistake. Those are Buffett's words. Buffett wasn't wrong. But reading a structure and capturing the biggest fruit from that structure are different problems. Those who avoided the crisis and those who ate what came after. They are not the same people. The .com bubble left two things: losses for millions and opportunity concentrated in the hands of a few. This is how crises operate. When a bubble bursts, wealth doesn't disappear. It moves to those with cash. And those who take the most are those who never left the ghost town. The old questions must change. Not why did this company collapse, but where did its assets go? Not who avoided the crisis, but who stayed in the ghost town. When the next gold rush is declared, am I a miner? Am I selling shovels? Or am I the one waiting for the ghost town? When a bubble bursts, what disappears is expectation. But some things don't disappear. People, technology, customers, roads, warehouses, servers, the empty space in the market. Who took that empty space? When the next gold rush begins, where will I stand?